Hi traders, Gavin McMaster here from Options Trading IQ. Did you know that 90% of options expire worthless? Well, today we're going to dive into the concept of time decay, how it affects options, and today we'll dive into the concept of time decay, how it affects options, along with strategies to leverage time decay. So let's jump in. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So time decay, or theta, is an important piece of the options puzzle. As time passes, the value of an option gradually erodes. Theta measures this erosion and represents the daily decline in an option's price, assuming all other factors remain constant. Theta strategies are designed to take advantage of this time decay phenomenon. These strategies involve selling options to collect premium and benefit from the gradual decline in their value over time. You may have seen a graph similar to this showing the time decay of an option. It begins slowly at first, and then as we get towards the last week or two, that's when time decay really starts to ramp up. One popular strategy is the covered call. An investor who owns the underlying stock sells a call option against it. Pretty simple strategy. This is where a lot of people will start with options. By collecting the premium, they generate income while hoping the option expires out of the money, allowing them to keep the premium and their shares. Let's look at an example. So here we have a covered call on Nvidia, buying 100 shares of the stock at $125.90, and we're selling a slightly out of the money call option. So the first strike that's out of the money, receiving $710 in premium for selling that option. You can see we've got a total profit potential of about $810, which includes about $100 of capital appreciation in the stock price, and generating a really nice chunk of premium. And our break-even price is in between 118 and 120. Now, if we look at our theta column, one of our most important Greeks, this is what most option traders are interested in, we've got a theta of 12. That basically means that with all else being equal, this call option is going to decay by about $12 per day. If we decide to go with a further out of the money call, here we're doing the 140 call, so we're allowing the trade much more capital appreciation. We're not generating as much premium, only generating $270. Our break-even price is a lot closer, but we've got a lot more capital gain potential. So our overall return potential is a lot higher if the stock heads up towards that strike price. Theta is only a little bit lower at $10 per day, so pretty good theta still on this one. Out of the money options tend to decay a lot quicker than at the money options. The last example we'll look at is going further out in time. So similar to the last example, we're going to use the 140 call, but we're going to go out to December, generating much larger premium because there's much longer in duration. Our maximum profit still occurs at 140, but it's much higher thanks to the higher option premium received. The slight trade-off with going longer term is our theta is a bit lower. So in this example, $6 per day in time decay. Another theta strategy is the credit spread. This involves selling an out-of-the-money option and buying a further out-of-the-money option, both within the same expiration date. The goal is for the spread to decay in value over time. So we've got two examples. We've got a bull put spread or a bear call spread. And let's look at an example. So here we've got a sample credit spread on Nvidia. We're selling the 115 put and buying the 110 put, generating about $100 in premium and $400 at risk. And we've got positive time decay on the option that we've sold, but we've got negative time decay on the option that we're buying. So $8 a day in time decay here that we're gaining. This one's losing $6 a day. So on a net basis, we're getting $2 per day in time decay. So lower theta than a covered call, but also a lot less risk because in this example, we're only risking $400. That's our maximum loss. Here's the bear call spread example. We're selling the closer in option, so still out of the money, the 145 call. We're going further out of the money and buying the call to create the spread. Again, we've got similar theta decay, +8 on the short call, -6 on the long call for a net theta of $2 per day. The Iron Condor is a theta strategy that combines a bear call spread and a bull put spread. By selling both a call spread and a put spread, traders aim to profit from the decay of time and a relatively stable market. So now we've got our Iron Condor. We're combining the bull put spread and the bear call spread to create more or less a neutral trade. There's a little bit of skew in this stock at the moment, so we're not quite in the center of the Condor. I can cover that in another video if you've got any questions. But basically, we're getting extra theta now because we're getting the positive theta on the bear call spread, positive net theta on the bull put spread as well. And we've generated extra premium by selling both spreads, which has also reduced our capital at risk. While theta strategies can be profitable, it's important to understand the risks involved. Adverse market moves or volatility spikes can offset any gains made from time decay. Risk management and proper position sizing are crucial for managing trades. Understanding how time decay impacts option pricing is crucial for successful trading. To learn more, go to optionstradingiq.com/option-education and search for any topic of interest. We've got over 2,000 articles there. If you enjoyed the video, please like, comment, and subscribe. Thanks for watching and have a great day.